Hey, welcome back. Steve Olson here. I had a few thoughts this morning that I want to share. We're going to editorialize a little bit. We talk to a lot of investors and we kind of hear some recurring themes. So I try to give you data and information. I mean, yeah, I'm a little biased. We like people when people invest in our properties, right? Full disclosure. This one's going to be a little bit more stronger on the opinion side. I want to talk about timing the market because I hear a lot of talk from investors. I was at a mastermind recently too, and there just seems to be this general feeling in the air of investors wanting to invest, but they're just kind of waiting for something better to happen. Are prices going to go down? Are interest rates going to go down? Is something going to happen? And as we sit here in early 2025, we got a new president. The Fed yesterday just held interest rates steady. People it's this general feeling of like, I just feel change in the air. And until everything is perfect and everything is safe, I'm not coming out of my bunker. That's not how it works, right? In fact, generally it's the opposite. When everything is safe and feels great and everybody rushes into the market, right? You could argue, is that a good time to invest? So I prepared a few thoughts and I've got my iPad down here that I'll just kind of consult on if you'll forgive me for that. But a couple of great quotes on the topic from some legendary investors. You may have heard of Peter Lynch, right? When it comes to timing the market, Peter Lynch said, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. I can't time the market and neither can you. If that offends you, I'm sorry, but you can't do it. It is so big and so complex, nobody knows exactly what is going to happen next. Another guy you may have heard of, Warren Buffett. He's a stock guy, but I think this still applies. Our stay put behavior reflects our view that the stock market serves as a relocation center at which money is moved from the active to the patient. Are you always bouncing around trying to get the next best deal, or are you just patient? It's a great quote. And the last one by Terry Smith, there are only two types of people when it comes to market timing. People who cannot do it and people who have not realized that they cannot do it. So I hope that makes the point because I mentioned in a previous video that I was at a mastermind and somebody raised a great point. A lot of the investors that we work with are high net worth and some are not. But let's say you're an investor that makes $20,000 a month or $30,000 a month and you're buying rental properties. Are you really in the grand scheme of things in your investing going to stress out about, oh, this property makes $50 a month in cash flow versus $150? I'm not going to do it. Now, if it's a neighborhood issue or a demographics and what's growing in the market issue, I get that. But if you're just looking at that cash flow and that's keeping you out of the market, I don't think that you're going to be waiting around for something that's going to be drastically better, right? It was a good point. So what I want to talk about here is when we invest and we are patient, we let the market do its work because unless you're out there creating alpha, right? Adding value to investments. You're doing something to drive rents. You're increasing property values somehow, right? Then it makes sense to just get in the market and let the money do its work. Let time do its work. That's your best asset here. So when we talk about waiting or trying to time the market versus being patient, let's talk about patience when it comes to cash flow. When we invest with patience and you have a 30-year fixed rate mortgage, right? You are going to win over time. Your property taxes, they go up over time. Now, I did get a property tax notice that I had a surplus in my escrow just yesterday. So my tax bill went down a little bit because the market that this property is in softened a little bit this year. That does happen. You should not invest in real estate because you're afraid of markets periodically softening. Markets breathe, they go in and out. It needs to happen. Right? But it shouldn't be the basis for your investment decision. So property tax, they're going to go up over time. Your insurance goes up over time. I cannot think of the last time that I got an insurance quote that I was happy about. They're always going up over time. That's just cost of doing business. Rent typically goes up over time. Yep, it can soften a little bit. And maybe you invested in a bad market that had some demographic problems or in some employment issues. That's certainly something you do have to consider behind the scenes of all this. But typically, it goes up over time. Maintenance goes up over time, right? Stuff just costs more to replace and to fix. And especially because we're not putting a lot more qualified labor into the labor pool, right? I've got daughters and, they want to be influencers or do TikTok or whatever. I don't even know if we can still do TikTok, but that's what they want to do. They don't want to be plumbers, right? So maintenance goes up over time. But guess what doesn't? Your mortgage. You get that 30-year fixed rate mortgage and that thing stays put. And that is where you really, really win with residential real estate investing. Let me give you some perspective, and you can look this up on your own. I've got some more detailed case studies where we will superimpose charts and stuff over what we're talking about. But according to the Federal Reserve economic data, since 2007, because we all know what happened in 2008, so I picked 2007 on purpose. Since 2007, the price of a home in the Dallas-Fort Worth metro has tripled. You can find all kinds of little blips along the way. You can find some yeah buts. But if you got in 2007, are you a happy camper right now? Right? You didn't actually even have to hold a super long time. You probably could have held till 2013, 2014 after what was a huge correction, right? And you'd still be a happy camper. I looked up the same data in Birmingham, Alabama, our other market. Since 2007, prices have increased 56% in Birmingham. And that's been a mild market. We would argue that there's a lot more room to run because it's kind of undiscovered as these big southern metros get more and more expensive. They're still great places to invest, but people will look for affordability, and Birmingham is a prime candidate for that and is starting to experience it. So let me propose to you 3 scenarios. And like I said, I'm editorializing. I'm giving my opinion of why you should invest today instead of waiting for some future event that may or may not happen. I had our lender, JT Lindsay, who I will have on the show soon. He told me today, if we, as the property seller, contribute 2 points to buying down your interest rate, which we have that slated into a lot of our models, and then you as the investor contributed an additional 2 points, you're going to get an interest rate on a 20% down loan for a single family new construction rental of 6.625%. That's today, right? So if you invested in a property with that 6.625 rate today, and over the next 5 years, rates stayed where they are you happy that you invested? I can't find a reason why you wouldn't. You got your money to work, right? You got those tax breaks. You got all those ideal benefits that we talked about last time. Scenario 2, you invest with a 6.625 interest rate, and over the next 5 years, rates go up. Are you happy that you invested? I'm going to say that yes, you are, right? And this is assuming you bought in markets where you've got some population growth, some diverse employment. They're landlord-friendly markets, right? I'm going to say that you're going to be happy about that. Could that lead to a compression in values somewhat if prices or if rates go up? Probably, but take me out to 10 years, right? I think you're still going to be very happy. So the third scenario, and this is the one that drives me a little bit nuts because people wait for rates to go down before they buy. All the properties that I own, all the properties that you own, right? If rates go lower than where they are when you bought, you're going to refinance. If you buy at a 6.625 and rates go down, either refinance to that low rate and lock it in for 30 years. That's the miracle of the U.S. 30-year fixed rate mortgage, or sell the property. Oftentimes when rates really take a dive, values accelerate. And see, that's the funny thing. I was bagging on timing the market earlier. That's one way that you can, right? Because when you lock in that financing, that is quantifiable, that is a certitude, and you can bank on it. And if rates go down and values accelerate, plain as day, right? You can sell, you can time the market in that instance. So those are just some thoughts on me, editorializing about this wait and see for some magical moment. In markets where you've got population growth, you've got low unemployment, you've got landlord friendliness, if the deal makes sense today and you can invest your money and watch that growth happen over time, watch that cash flow increase over time, watch that equity happen over time, why wouldn't you? Anyways, thanks for having me. We'll see you next time.